Still trying to tiptoe through the middle. I mean, my observation for a while, and I mean, I don't want to sound flippant, but you know, the Brexit process isn't going very well so far, and I don't think that's really improved. And I think the thing to do in the UK market is there is plenty of stocks that aren't really that reliant on what's happening in the UK economy. So you're kind of looking for, you know, you can call them Brexit hedges if you like, commodity markets, you know, oil stocks, mining stocks, you know, not very reliant on what's happening here. Telecoms may be interesting, healthcare. I mean, the flip side is people say, you know, you just had the house builders up on your board there, all down 7%. You know, there's carnage in the bank sector. Surely these are opportunities. I mean, they might be one day, but I don't think that day's here yet.
The banks I mean, they're all off the naughty step pretty much now after the financial crisis, and actually most of them are back to paying income. Yeah. Why, if you run an income fund, would you not be attracted to that income, given that we've probably had the worst for the banking sector? Whatever's going on with Brexit, the UK economy actually has some momentum at this point. And most of them are financially quite robust.
Yeah. So, I mean, I've come from a position of having no banks a few years ago to owning some, and so, you know, I take your point. Has been a lot of progress in the last 10 years since the credit crunch. It's perhaps been slower than you might have hoped, but you got to a point now where all the banks are sensibly capitalised, although there continues to be sort of regulatory creep. So Lloyds Bank, for example, spent a long time saying once we get to 13% core equity tier 1 capital, we'll have enough capital, and that means we can start spoiling shareholders. And now it turns out 14% is the new 13. So actually, you know, the earnings go back onto the balance sheet rather than coming out to shareholders. And you know, that still seems to be a long process of, you know, of regulatory creep, that, you know, you think you've got enough capital, but actually it's always a bit more required. You know, banks will never be in a position where they're allowed to make great returns. I mean, the regulatory regimes are just going to be tougher forever. But, you know, Lloyds is a relatively sensible bank, but it's very much, you know, a UK bank. It's got a very big mortgage book. If you're worried about house prices and, you know, consequences of, you know, a hard Brexit, you know, biting into the economy, then, you know, I'm afraid Lloyds is going to be the front line on that.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.